Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 9th, 2024. S&P 500 currently sitting at 5021. I'm David Zarling. I'm here with turf management extraordinaire Ian McMillan. Another week in the market. Markets moved a little higher.
Yeah.
It can't possibly continue, right?
I think that continues to be I don't know if it's the majority belief, but certainly a significant chunk of market watchers. Yeah, I mean, you're still a market participant, right? Even if you're not invested.
Yeah, I would think if you don't have a position, that's still an opinion, right? If you don't own a share of something or you're not involved, that's an opinion too. I agree with that.
Yes, so a pretty solid week overall for stocks. Looks like Russell, our black sheep of the family, is going to end up having the best week. Still a lot of ground to make up on the rest of the siblings. Dow flat for the week, but S&P and NASDAQ, right? And these are indices that have already been at all-time highs. We continue to, new highs are bullish. And here we are weeks later, 8-9 weeks on the NASDAQ after breaking the new highs.
Well, in our new highs, bearish, Ian?
Well, no, I mean, I think that's what we've said all along. That was my point. I mean, these things that make new highs continue to go, and that's what we would expect. Same on the opposite, new lows. You would expect them to keep making new lows. One day they won't, but not really my job.
Right. And once you get to new all-time highs, what we know when we study markets is they tend to cluster. Like one new high begets a new high, begets a new high, which is the very definition of a trend, right? If you haven't gone anywhere for 2 years, such as using something like the S&P 500 as a simple metric, 4,800 was a level it hadn't surpassed in 2 years until, let's be really specific, January 19th. And we continue to cluster the recording of new all-time highs in that. That doesn't mean there's not going to be some type of correction this year. We know markets experience 3 to 10% corrections frequently. But at the same time, one of the most bullish things that could take place is that there's so much demand that we pay a price that's above any price that's ever been recorded.
That's how it works. That's why stocks have gone up for over 100 years.
Right. The willingness of participants to create enough demand to outpace supply to levels that haven't been seen before. Now, that doesn't mean we can't have pause, right? In a seasonal period, like if we look at Valentine's Day, not to bring it into some romantic thing, but if we look at seasonality, mid-February is typically where we see some seasonal weakness in an election year. Could we see that this year? Absolutely. Especially after the move we've seen since the October 23, November 23 lows. We've had an aggressive move. Since mid-December, we've seen some stocks not make new highs, so a narrowing market. But that's also pretty standard fare for bull markets, is that there's times where there's really good participation, there's times when there isn't.
Yeah. No correction through price yet this time around.
And some people seem to forget that you can correct through time. Let's say we do correct. Well, there's 2 ways. It's one through price, and maybe we get a 3 to 5, maybe a 10% correction, a pullback in. But the other option is we build a range. We move sideways for a while. That would be perfectly normal. It appears that there is some sentiment out there, and I don't know how to put this other than it seems like one foot out the door, that the next major correction is upon us. We don't know. Like it could be like Monday, we could see markets correct and never see these levels again. We could never see the round number of 5,000 in the S&P again. There's no way to know that. But the only way for that to be the case is if we pass through 4,800 first, and then 4,600, and then a 200-day moving average. So there would be some information that we'd be able to look at. But from a trend following perspective, Ian, is a trend follower out at the top?
No.
Not really how it works. So while some might have said, hey, buy stocks during the World Series and sell during the Super Bowl, I don't know if that's the case. Kudos to you and your Chiefs. I forget the data already. Like, I know the Chiefs have been in the last 6 AFC Championship games.
Yeah, something like that.
What is it for the Super Bowl? Like, it's pretty impressive in the Mahomes era, right? Like,
Or the last 5 or something like that.
for the last, like, that's incredible, which is why 2 episodes ago we talked about dynasties, one of them being the Chiefs. I would argue, I know you would be more humble about it because you're a Chiefs fan, but from an outside observer, it's very obvious that the Chiefs are a dynasty-like team, and so are markets. Do you have any predictions for Super Bowl Sunday?
I think I gotta go with my Chiefs, obviously.
100%. I mean, that's the trend, right?
If the NASDAQ and the Russell 2000 were playing, I would just bet, right? If they played 1,000 times, I'd bet on the NASDAQ 1,000 times.
Yeah, especially over the last decade.
They got the superstars, so
it should be an amazing game. I mean, I'm a huge Mahomes fan. I really appreciate Brock Purdy. I think both teams are fantastic. Some would say this is the Chiefs' best defense they've ever had. I don't know that answer.
Yeah, I would say so. I mean, definitely since Andy Reid's been there. Spagnola's been the DC for a few years now too, and they're pretty
He is
awesome.
a good defense
What they
coordinator.
did just in the playoffs too. I mean, Dolphins didn't do anything on offense.
Yeah.
Lamar
Baltimore didn't do anything.
Yeah.
That's a good point. That's a really good point. I look at the teams. Well, this sounds a little bit ludicrous, but the 2 teams that are in, it's going to be a heck of a game. I wonder if they're going to set viewership ratings on this, just because I don't have skin in the game. Like, neither of my teams are there, but like, these 2 teams are legit. So it should be a pretty great game.
Yeah. I think it'll be good.
We have this market that is definitely US centric. We can all agree. Like, when we look at relative charts of international, if we say something like VEU, Vanguard, all world minus US compared to the US, still in a massive downtrend. So if we just focus on US stocks, it's very apparent, you just highlighted it, that we continue to make new all-time highs. And that's about as bullish of a thing that you can do with the backdrop of, hey, mid-February into mid-March is seasonally weak in an election year with an incumbent. Do we see a correction from here? We don't know. I mean, we have to wait till price shows us that. That's just the reality. And then you consider small caps, which we've dogged on, right? I think you call them black sheep. In some aspects, you can make the argument that they're firming up this week. And you highlighted that since the breath rust late last year in October and November, small caps have led. And here we are on a relative basis back at those levels, and we're seeing it firm up at a higher level than. So if you think about the range of like IWM, what I want to paint the picture on is I shouldn't say we all are. The new listeners may not be, but there's a range in small caps using the Russell 2000 that goes back to April of 2022. So that's a long time. We're only 45 days away from an April of 2024. And we've moved in this range that's been 20% in depth. And we're right now against that upper boundary. Do we really get to be surprised if there's a rotation in the small caps at this point? What do you think on that, Ian?
Yeah, I think it's very possible. Be a sight for sore eyes.
Yes, it would be. The reason why Ian says that is when you think about, we've talked about all-time highs on NASDAQ, S&P 500, Dow Jones. IWM is still 20% removed from its all-time high. And so it'd be really nice to see small caps regain their strength, regain a trend. We've been trendless since that April of 2022 period. That's for some, that's a fair amount of time. For some, that might be a child reaching a new milestone. For some, it might be something that's happened in their life that feels like forever ago. and now we're on the verge of small caps breaking above 2,000. That would be hugely significant from an evidence standpoint. And at this point, Ian, where would you like to take our listeners from a weight of evidence standpoint? What are some things that you're noticing from the past week that are worth covering?
Yeah, still a lot of growth. Even with Russell outperforming this week, small cap growth continues to significantly outperform small cap value. Obviously, I'm sure that has a lot to do with this regional bank thing the last couple weeks. But nonetheless, so all market caps, I think you got to continue to lean into growth. Now, visually, it's been a pretty big, you look at these relationships on a chart, pretty big moves. So short term, I don't know who outperforms, but clearly, I think there's still overall more demand for the growthy type of stocks out there.
When you say growth, I think when we think big cap, right, mega cap, large cap, right, that's semiconductors, that's tech. When we're talking about small cap starting to gain traction, is that the same? Like, are we, for small cap growth, is that the same dynamic? Is it tech? Is it, like small semiconductors? Is it small software? When we talk about small cap growth, what does that look like? And maybe it looks the same. This is a genuine question. Is this the same as large cap dynamic, or is it a little bit nuanced for small cap growth versus a large cap growth thesis?
Say that again.
We know that for a long time.
Oh, yeah. You're asking if it's also tech?
Yeah. Is it small cap tech? Is it small cap software? When we talk about growth across cap sizes, right? So, and my point is large cap growth, we think of semiconductors, we think of software, we think of tech overall. Is that the same with the small cap arena?
Yeah, I assume that, some tech in there.
Because when I think of the makeup of like, what did you say there? Biotech?
Yeah.
So that would probably be.
Sure, that falls into growth.
Oh, absolutely. Healthcare. So small cap healthcare, biotech, that's a little bit.
I don't know where industrials, I guess classic market is industrials get put into value, I guess, right?
Yeah, I don't know why that is.
If someone had a gun to my head, I guess I would put them in value.
Do you know Amazon's selling those small houses now?
Like the ones that Home Depot does and stuff that sells?
Oh, I'd have to look. They're these like, the way I would describe them is they arrive, they look like a shipping container, but you can unfold them.
And then the walls fold down and you got a little porch and stuff.
Yeah. Like that's pretty sweet.
I believe it. All these kids that live at home these days, in their 20s and 30s, parents probably want them in the house. If I still lived at home, my dad would probably put me in a shed in the backyard too.
Are you saying they're throwing these up in the backyards?
They might be. Or this is just how people are, maybe, young couples, young individual,
Dude, that's so awesome. Like,
I guess if you could buy you could buy an acre, how much do those little homes cost?
I looked this up and I thought it was like somewhere between 19 and 26,000.
Yeah. Take out a 30-year mortgage on that, because they will. $50 a month, and
that's too funny. We could talk about Amazon in a second, but you mentioned small cap healthcare, biotech is a little bit nuanced from a small cap versus large cap theme. If we're going to see small caps move higher, probably there's some biotech backing.
Yeah.
Do you think some regional bank backing falls in there too? Like,
you're going to need it to go up.
Because it's based on the indice construction.
Yeah.
Because when we look at small cap weightings, it's like you mentioned, it's industrials, small cap healthcare, and biotech. And then there's the regional banks in there. Those are your like top four when we look at small caps. That's a really interesting perspective because you don't necessarily hear a lot of people talking about, well, there's a lot of talk about narrow breadth. Since mid-December, we've seen narrow breadth. Narrow breadth is defined by less new highs happening. But I would make the argument that Grant Hawkridge, technician who does good work, he's also highlighting that there's less new lows happening. So yes, there's less new highs happening, broadly speaking, but there's also less new lows happening, broadly speaking. That's important information. If we were seeing an expansion in brand new lows, that would be information. But we're breaking out to new all-time highs. We're seeing some leadership out of biotech, small cap healthcare, small cap industrials. We talk small housing, but housing overall, you look at something like XHB versus S&P breaking out of a massive base.
I think that's going to continue to be one of the, and it was, home builders were strong last year.
They've been since spring of 2022, and that's the effort it took back to get to a horizontal level that they haven't seen since, I believe, since 2008.
Yeah.
2007.
Yeah, they look good. And obviously lots of angst surrounding that industry and how much things cost and who can afford what and mortgage rates and yada, yada, yada.
Well, I'll make the argument that in the first time in my lifetime, and I won't tell you my lifetime, but that you could build a house and have it be worth more the day you took ownership, took the keys, then that's the first time we've seen that value be higher in the last 30 years.
So it's like you build a house yourself.
Right. You build a house yourself, you go with a builder, you build a house, it's worth more after you've taken the keys. Whereas for the last 30 years, it typically was you took the keys and you paid an opportunity cost for the next, let's call it 3 to 10 years, where you couldn't turn around and sell it.
And you're talking about for like a brand new house?
Yeah, brand new house. So we haven't seen this type of dynamics since the early 80s, late 70s, where you could build a new house and have it be worth more when you took the keys than the environment leading up to this point was you paid a premium for that new house and you had to sit on that opportunity cost for 3 to 10 years. Does that make sense what I'm describing? So the value, go ahead, sorry.
That makes sense.
Here you have that backdrop to something like XHB versus the S&P breaking out of a base that goes back to 2007. That's heavily weighted towards the evidence that we're seeing home construction and home building being outpacing the performance of the S&P 500. And that's a major sector of the US. So if we're saying that US stocks are outpacing international, and it's not like I'm not here to slam international. I'm just saying that from an opportunity cost perspective, you have the DAX, the German DAX, highly correlated, making new highs. You have the Nikkei making new highs, but they're not making new highs at the same pace that the US market is. And one of the major factors in US markets is housing. And you have a housing sector that's breaking out on a relative basis, massively speaking, going back to 2007. That's a really important information, in my opinion. That's why we use charts.
Tough to do without them.
It is. What else are you seeing, Ian? I know we're kind of skirting the edges of what's going on international. We could talk bonds, crypto. I don't think we're going to talk about commodities, but we could.
Yeah.
Where do you want to take things?
What's going on with the Bitcoin? And look at this. Nice move this week.
Bitcoin. Digital gold, not gold.
We'll see. Maybe building some type of range here. Maybe just, we'll see. We'll see. But above 47,000, which is where they'd sold it back in early January. After coming off a good run. I mean, obviously you got to assume that it goes up over the next, right? Because that's the way the trend is going. But it can consolidate for a while. I mean, look at March 23 to October 23. That's 8 months. Big range. 20% plus moves. Multiple. Yep. So obviously a high beta asset. I think that's pretty well known at this point. But overall, not too shabby. Was it you that mentioned that it's back up when the ETFs come out?
Yep. So we're back at a Bitcoin price level where they released the Bitcoin ETFs, 11 of them.
Yeah.
And that's where, you bring up a good point where sometimes we don't cover enough on this podcast trends. And what you're saying is that the intermediate term, so like let's call it 6 to 18 months trend of Bitcoin continues to be higher. So until that thesis is broken, why would we expect anything else? Is that a fair way to assess that?
I think so.
Okay.
You just
So,
assume, right? Momentum is momentum.
yeah, momentum is momentum.
Eventually, if you roll a ball, it'll, hit a wall and stop, I guess, or come to a stop. I guess it can roll to a stop without hitting anything. Yeah, as I was saying earlier, not our job to predict tops and bottoms.
You will never know that in real time.
Been a lot of tops predicted over the last 140 years.
Yes. People love to pick tops for whatever reason and like to think they can pick bottoms. Nobody knows that. Only the market knows that. And that's a very offensive part of being involved in markets is those listening, you and I, there's times where we think that somehow we know more than the market. And that's just not the case. The market knows more. I gave the example in the last Lunch and Learn that the corrective behavior of the market that we saw in 2022, that happened. The correction of 25 to 35%, depending on what you're looking at in 2022, heading into 2023, that happened prior GDP numbers being revised downwards most recently. So the market knew before the government knew that there was a contraction in business activity. And that's why Ian and I submit ourselves and we ask our listeners, hey, you might want to submit your opinions at the door and just look at price, look at supply and demand, observe that type of behavior, because it appears over and over and over that markets know more than we do. And when we look at that, when we look at it from a big picture perspective, so when we think of like risk on, like what are you going to do when risk is on? What are you going to do when risk is off? Are there some relationships there, Ian, that we can look at and say, that is risk-taking behavior, which tends to be coincident with markets moving higher. And that's risk-off behavior, which is coincident with markets moving lower. Anything that you're looking at in that perspective?
Well, relationship-wise, I think we continue to see things like staples, utilities, real estate all hit. They continue their downtrends.
We've done a really good job highlighting how
3 areas you want to see just continue to be weaker.
Yeah, you've done a good job highlighting that when staples are underperforming the S&P 500, that is a more risk-on scenario.
Yeah.
Whereas if they're going down on an absolute basis, but down less than the market, that's a risk-off scenario, and that's not what we have.
No, they've been in a strong. Staples is in a very strong, low volatility uptrend. They're down today. They're down like 1% today, but I don't really have any problem with them. Haven't got overbought in a while. So same with utilities. Utilities a little worse on an absolute basis.
Yeah, I was going to say, okay, let's be frank here. Utilities.
They look pretty.
That is bad. Like utilities.
Like broad sector. I don't even think, because I don't think real estate looks that bad. No, it doesn't. And I don't think staples or materials look that bad. No, they don't. Is this true? Is this the only broad sector below its 200-day moving average? No, energy is again today because it's flirting around up its 200-day. XLE is.
Right.
But yeah, utilities, I don't know. Is it a higher rates thing? Is it?
Well, and I will say on a relative basis, if you have utilities in your portfolio, it's a problem. You look at utilities versus, because this goes back to opportunity costs. So when you have a dollar, you have choices. That dollar could go towards paying a kid's tuition. It could go towards gas. It could go towards food. It could go towards investment. And then once I'm in investment, where's that dollar going? Am I investing in utilities? Am I investing in staples? Am I investing in growth? When you look at utilities, it's a little bit problematic. The opportunity cost from a relative perspective using something like XLU versus SPY, a little bit problematic, which makes sense when you look at the rate environment, I guess.
I mean, if those are, I guess I'm not going to put my macro hat on today. But yeah,
No,
they have the most fixed income exposure, right? Those are companies that issue a lot of debt. So if it's just going to cost more and get harder to issue debt,
where do you hang your fundamental hat?
in the bathroom. No, fundamentals are fine. It's just not
Good.
the way that
It's
I
good.
choose to participate in markets. Doesn't fit my personality.
I could imagine that's hung right next to the toilet paper.
I mean, I think everyone starts off as a fundamental.
Oh, 100%. That's where I came from.
Yeah, I don't know many people, maybe more so today because it has become, if you're online now, like the kids are looking at stuff about the stock market, you have a much more higher probability chance of coming across and being introduced to technical analysis than 10, 20, 40 years ago.
Oh, 100%. I would even make the argument that you have no excuse at this point. Like if you're trying to figure out, do I matter or does the market matter?
Try it out.
You have no excuse at this point. There
Try
was a time.
have an opinion, disagree with the market on something, whatever it is. Market's gone up too far too fast. This stock is overvalued. Pick your headline and bet against the market and or the trend of the market. And let me know how that goes.
Yeah, right. Exactly. Like there is no more.
Do it 100 times and let me know how it goes. That's a better way.
There's no more excuse. Like when we're talking about charting stocks on paper, and all you have are the barons of the world, meaning the publication. We're in a new era. Think about all the charting platforms. You can go study supply and demand on 5 different amazing cloud-based platforms and still try to think that your opinion matters more than what's happening in supply and demand with a chart. You can go ahead and do that. That's fine. But in no time in history have we seen an era where that availability to the information is upon us. Like I get it. There was a time where all you had was somebody else's opinion as your opinion. But
Yeah.
now you have access to price charts, holdings. What does this ETF have inside of it? What's the weighting of that information? What does that look like on a relative basis? There are no longer excuses. Like you're either going to marry your opinion or you're going to acknowledge that supply and demand are bigger than you. And that's a very hard topic because ego is a problem. We love to think that we're smarter than the market. And one of the reasons why technical analysis was so appealing is because it became very apparent that my opinion didn't matter. I can have all the opinions I want about mortgages or real estate or
credit card debt. That's been a big one.
Yeah, credit card debt. That's a perfect example. Like I can have an opinion on that, but does my opinion matter? No, the market matters. And that's very offensive. Like that's an offensive to the ego statement that the market knows more than me. Because I like to think that I know more than people. Well, that's simply not true. And that's offensive. And it's why we use charts. It's why we submit to supply and demand. It's why we submit to absolute and relative charts. It's why we submit to trends and momentum. Ian is covered on here ad nauseum. I mean, what episode are we on? We're 190 plus episodes. And Ian has highlighted numerous times relationships, trends, those things that matter that usurp our personal opinions. And that's hard. Like if you're listening to this and this is, a first time revelation, it's hard to accept that the market knows more than we do.
Yeah, I think you've just got to. I think I was just tired of, being right in my head. I mean, the Seeking Alpha article told me it was undervalued. And
Yep.
then having it waiting months for a thesis that's supposed to, right? Because that's a lot of what we feel this stock is undervalued, and over the coming 3, 4, 5 years, we think that the market will realize the value of this stock, and then blah blah blah. That's the whole
Right.
Thesis behind that. And that's just like, dude, I'm not waiting around 3 years to see if I was right about something. I just rather know within a couple days or a couple weeks.
Our listeners don't get to see some of our internal conversations, and you and I, Ian, have had some heated conversations and much appreciated. Like Ian and I want to get to a point of truth. Like there's no sitting here and like, hey, let's wait, let's see what 3 years looks like for truth. Same thing with our spouses. Like who wants to know 3 years later, right or wrong? How about let's use the information that we have now. And that's the beautiful thing about using price charts is we get to know, am I on the right side of the trade or am I on the wrong side of the trade? And right now, when you look at the market, basically since the end of October and beginning of November 2023, Ian, how many things could we look at that points to higher prices? I think of like FANG stocks as a collective versus the S&P 500.
Yeah.
They continue to make new highs. That is confirmation of risk on behavior. Anything else in that arena of like a risk on behavior that you see that's like, hey, let's look at
semiconductors, internet stocks. I guess that's very
internet
not all-time highs.
Yeah.
50 reaching 18-month highs today.
Wait, what is that? What were you talking about?
50.
Oh.
Obviously, your techs.
FFTY.
Yeah.
You're talking about the IBD, the Investors Business Daily 50 being a new
highs.
Yeah.
Mega caps, we talked about home builders, mobile payments, which is fascinating to see mobile payments ETF with PayPal. I mean, I think PayPal, this is an interesting one to me. And I think we're going to look back I don't know what the reason for is, but PayPal has not recovered during any of this market rally. Okay, yeah, it is up after its October lows. But when you look at PayPal, this chart does not say, wow, this is a stock that like large important institutions want to own in the next 12 to 24 months.
I completely agree. And what the irony, I don't know if it's irony, right? Like PayPal, you tell me, Ian, you are younger than me. You are on the cusp, the leading edge of family creation, wealth creation. Like PayPal to me was the first non-banking way to handle money.
Yeah. Well, I think it's still pretty popular.
It absolutely is. But what's fascinating is you look at something like ARKF, which is your newer age financials versus. Say that again.
So it looks pretty good.
Yeah. So it's a different. It's not just PayPal. There's other things happening in the financial transaction part of the business that is worth paying attention to. You look at ARKF versus financials overall. That's
Square looks a lot better than or Block. I guess it's called Block now.
It's called Block. So there's information there too. And like if we look at like high beta versus low vol, that's a quality retest in that relationship, moving higher. When we look at small caps versus S&P or equal weight, Sometimes clients will be like, when I bring up, hey, do you know there's more than one S&P 500? They'll look at me a little bit. What I mean by that is there's a equal weight S&P 500, there's a reverse weight S&P 500, and there's a cap weight S&P 500. When we look at equal weight S&P 500 versus the S&P 500, we are at a logical point where you could see equal weight outpace cap weight. And cap weight has had quite a run. And then you throw in things like, I think I already mentioned high beta versus low vol. You throw in how would I call this? Like ICVT versus AGG. So aggregate bonds being the denominator, but you're looking at your more high tech credit, ICVT, that's seeing accumulation. So we continue to see risk on behavior. If I were to flip the script and say, hey, everybody listening to this, wow, Dave and Ian sound relatively bullish. What are the things that give you pause or this is where the thesis is wrong? The risk off is about to happen. Below these levels is where we would see risk off behavior start to kick in. Do you have any thoughts on that, Ian?
I guess S&P below 4,800 would really be my only thing I'm worried about for now.
Well, I think that's good. I think that's appropriate place. I think small caps using IWM, if we're not, this is setting up to be that small caps lead the rest of the way from here since February 2024. But that's only true if IWM is above the volume weighted average price around 188 using IWM. If we're above that and we're continue to see relative outperformance, that's a good thing. Like as Ian said, if you see the family member who's been in trouble, who isn't doing their contribution, isn't providing to the family, is off doing things they shouldn't be doing, and now comes home and starts to perform. I mean, how long has it been since we've seen small caps do anything?
Yeah. Still on the
time.
skeptical side. Got the job. Now we need to get an apartment, start paying our phone bills.
So true. I mean, we're going on 18 months of small caps doing absolutely nothing. To your point, that it would be great to see that part of the market start to contribute and actually start to lead. And I understand the overall, I don't know if sentiment's the right word, but we have bull markets can happen without small caps. That's just a fact.
They can.
But if small caps participate or the leaders, also fun. And the only way we know that is if we see small caps, if you use IWM above 199, 200, if you use futures, 2000, 2100. And at this point, we're not exactly the end of our time, but we're close. We've spent almost all of our time on US equities, anything fixed income, crypto, commodities, international that you want to touch base on before we wrap it up.
Dollar hanging out this week, still above 104. Not a lot of things going on outside of stocks. Obviously, we mentioned the move in Bitcoin earlier, and Ethereum also with a big move, but not back to its early January highs. That's probably it from me this week. Okay. Do you have something you are itching to get off your chest?
What I found interesting, and if you're listening to this and you're the one who provided this information, I'm trying aggressively to find who posted this. And Ian, I love your reaction on this, that NVIDIA is larger. So NVIDIA's capitalization is larger than all of Chinese equities from a US perspective. So your ADRs. That's pretty wild.
It is. Did you read that article?
Did you wait? Do you have the article?
Yeah, I read that. But
what do you think about it?
It's not what they're measuring.
Oh, that's not what they're measuring.
They're only measuring like the 8 shares on the Hang Seng it's like they're basically saying like, oh, it's bigger than the Russell 2000.
Yeah.
Using the headline to say all Chinese stocks, but it's not, because I Googled, is very quick. Obviously, the author of this horribly written piece could have also used Google. But I did see that market cap for all Chinese stocks is like 7.9 trillion. So not close to Nvidia.
Yeah.
But they know, because I look through the comments and all these people are, oh my God. And that's what they want, right? They know that most people are not going to go see, like, okay, is this actually true? Or like, how would that statement possibly be true?
That was my first reaction, and I'm glad you're correcting me on this, because when I saw that, I'm like, how could that be? And obviously you're pointing out that it can't be. It's not true. So thank you for that.
Yeah, I went and looked up that guy. Whoever.
What is notable, so Nvidia side,
Yes.
when you look at Chinese equities from a US perspective, right? What's available to us using ADRs, using something like FXI or ASHR, Asher, it is notable the horizontal levels we're at, the negative sentiment we're at. I'm not sitting here calling for a resurgence in Chinese equities, but it is notable that this goes back to the question of, is this where I want to take a new position? For example, is this where I want to take a new short position? I don't think that's what you can say for China. I'm not saying you need to be long Chinese equities, but are you really going to be short Chinese equities here? These are the questions that are ongoing. This is the reason why we use an adaptive process. Is price moves to a certain level in a certain degree at a certain pace, that you do have to ask yourself, is this really where we want to take a position, short or long? And I think you started out the podcast with, sometimes a non-participation is also a vote or a position. And so while we see Chinese equities at these massive relative lows, probably isn't the point where you want to be short Chinese equities. Not a recommendation, but just something to highlight. So Ian, we're kind of bumping up against the end of our time. I always like highlighting those who support our podcast. Those who are familiar with listening know that we like to highlight the Adaptive Select ETF, which is listed under the NYSE under ticker ADPV. This ETF helps investors access two of the most prevalent factors in markets, momentum and relative strength, using proprietary identification methods. Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. We are close to the end of our time. Ian, anything you'd like to highlight before we wrap it up?
I don't. Happy
No?
birthday to my dad, 81 today.
Yeah. Amazing.
He'll be listening to this Saturday morning. So big shout out to him.
That's amazing. Yes, happy birthday to Ian's dad. Happy birthday to my wife. And do you have a Super Bowl prediction, Ian?
I'll say Chiefs 24-14.
Okay. Dominant effort. I love it. I will be watching. I don't have a prediction. I just love two great teams playing football. But Ian, I hope your team wins and that you get to enjoy it. Everybody listening, we hope that you give this podcast a high ranking on whatever platform you like to use, and that you share it with your friends, because that is a reward to us for the effort that we put into this podcast. Thank you, everybody, for listening.
Have a great weekend.